Here's a belief that's costing people real opportunities, and it's completely false. You've probably heard someone say, "I don't want a raise, it'll push me into a higher tax bracket, and I'll actually take home less money." Or maybe you've believed it yourself. Here's the truth. That's not how tax brackets work. Not even close. And by the end of this video, you'll understand exactly why moving into a higher bracket can never, not once, not ever, reduce your take-home pay. The confusion comes from a genuine misunderstanding of how the US uses what's called a progressive tax system. Most people assume that if you're in the 22% bracket, all of your income gets taxed at 22%. That would mean earning $1 extra that bumps you into a new bracket could actually cost you money overall. That's not how it works at all. Instead, think of your income like water filling a series of stacked buckets. The first bucket fills up and gets taxed at the lowest rate. Once that bucket is full, extra income spills into the next bucket, taxed at a slightly higher rate, but only the amount in that bucket, not everything below it. For 2026, there are 7 federal tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Each one only applies to the slice of income that falls inside it. Let's walk through exactly how that works with real numbers. Part 1. The 2026 brackets and how income actually flows through them. For 2026, the lowest rate is 10% for single filers with income up to $12,400, and the top rate stays at 37% for single filers with income above $640,600. In between, the rates are 12%, 22%, 24%, 32%, and 35%, with the income thresholds for each one rising slightly from 2025 to account for inflation. The 2026 standard deduction for single filers is $16,100. That's the amount you subtract from your gross income before any tax brackets even apply. So if you earn $85,000 a year as a single filer, your taxable income isn't $85,000. It's $85,000 minus $16,100, which is $68,900. Tax brackets apply to that smaller number, not your full salary. Part 2. How the buckets actually fill up. Let's use that $68,900 in taxable income and walk through exactly how it gets taxed. The first $12,400 gets taxed at 10%. That's $1,240. The next chunk, from $12,400 up to $50,400, gets taxed at 12%. That's $38,000 of income, taxed at 12%, which comes to $4,560. The remaining amount, from $50,400 up to your $68,900 total, gets taxed at 22%. That's $18,500, taxed at 22%, which comes to $4,070. Add those 3 pieces together, $1,240 plus $4,560 plus $4,070 equals $9,870 in total federal tax owed. Notice what just happened. Even though this person's top bracket is 22%, they did not pay 22% on their entire $68,900. They paid 10% on the first slice, 12% on the next slice, and only 22% on the final slice. Part 3. Marginal rate versus effective rate. The distinction that clears up almost every misconception. Your marginal rate is the rate applied to your last dollar of income. In this example, 22%. But your effective rate is your actual tax bill divided by your income, the real blended percentage you paid overall. $9,870 in tax divided by $68,900 in taxable income works out to an effective rate of about 14.3%. That's significantly lower than the 22% marginal rate. If you divide that same $9,870 by the full $85,000 gross salary before the standard deduction, the effective rate drops even further, to about 11.6%. Here's the size of the misconception in dollar terms. If this person's entire taxable income really were taxed at their marginal 22% rate, they'd owe $15,158 instead of $9,870, a difference of $5,288. That gap is exactly what people are afraid of when they say they don't want to move into a higher bracket, and it's a gap that simply does not exist under how the system actually works. Part 4. Why a raise can never shrink your take-home pay. Let's directly test the myth. Say this same person gets a $5,000 raise, moving their taxable income from $68,900 to $73,900, pushing more of their income into that 22% bracket. Before the raise, $9,870 in tax, leaving $59,030 in take-home pay on that taxable income. After the raise, tax owed rises to $10,970, but take-home pay rises too, to $62,930. Take-home pay went up by $3,900. Every single time you earn an additional pre-tax dollar under this system, you keep a portion of it, even if that dollar is taxed at your highest marginal rate. The idea that a raise can put you in a worse financial position, dollar for dollar, is simply not how marginal tax brackets function. The one caveat worth knowing: this is about federal income tax specifically. A higher income can occasionally affect eligibility for certain income-based benefits or phase out certain tax credits and deductions. That's a separate, real phenomenon called a benefit cliff, and it's different from tax brackets. But within the tax brackets themselves, more pre-tax income always means more take-home pay. Let's bring this to life with two coworkers, Denise and Marcus, both single filers, both earning $85,000 a year in 2026. Denise believes the myth. She's turned down 2 promotions over the years because she was told the raise isn't worth it, you'll just lose it to a higher tax bracket. She's been operating under the assumption that her whole paycheck would suddenly get taxed at a much higher rate. Marcus understood the mechanics. When he was offered a $10,000 raise, pushing his taxable income from $68,900 to $78,900, he ran the numbers first. His tax owed increases from $9,870 to $12,070, but his take-home pay increases from $59,030 to $66,830, nearly $7,800 more in his pocket, even after the additional tax. He took the raise immediately. Same tax system, same brackets. One person's misunderstanding cost them real income over the years. The other's understanding of exactly how brackets work meant an easy decision. Here's the short version. The U.S. uses a progressive tax system with 7 brackets in 2026: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Each bracket only taxes the portion of income that falls inside it, not your entire income. Your marginal rate is the rate on your last dollar earned. Your effective rate, the one that actually matters for your overall tax bill, is almost always meaningfully lower because it blends all the brackets your income passed through. And most importantly, earning more pre-tax income can never reduce your take-home pay under this system. A raise is always worth taking. Have you ever heard someone repeat the "it'll push you into a higher bracket" myth? Or believed it yourself? Drop a comment. I'd bet almost everyone watching has heard this at some point. Next video, we're getting into one of the most misunderstood ideas in real estate. Is renting really throwing money away? We're checking the actual math. Subscribe so you don't miss it.